Home sales came in lower, which isn't too surprising given where rates have been, while builder sentiment softened a bit, showing that even builders are starting to feel some of that hesitation in the market. On the flip side, we did get a positive sign with wholesale inflation coming in a little cooler than expected, and the markets are paying close attention to that because any sign that inflation is easing can help take pressure off of interest rates. Good afternoon. We are once again up against a ceasefire deadline, and investors are closely watching for any updates on how things will unfold in the ongoing US and Iran conflict. Last week ended on a positive note after Iran announced the Strait of Hormuz was officially reopened. However, that quickly shifted over the weekend when Iran reversed course, claiming that the US had not upheld its end of the agreement. The messaging around this situation has been inconsistent, and that uncertainty has led to significant volatility across the markets. We saw that carry into the start of the week, with major indices opening in the red as investors weigh the potential outcomes ahead of tonight's deadline. If we see an agreement or even an extension of the ceasefire, that could bring some positive momentum back into the markets. On the flip side, continued back and forth and uncertainty will likely keep pressure on the markets and could push mortgage rates higher. Let's take a look at what happened last week and how it impacted mortgage rates. Here are your headlines. After a rebound in February, existing home sales slowed in March, falling 3.6% according to the National Association of Realtors. At the same time, housing inventory improved, rising 3% from February to 1.36 million homes, which is 2.3% higher than this time last year. So what is the takeaway? Even with this increase, inventory is still tight compared to historical norms, which continues to put pressure on the market. According to NAR chief economist Lawrence Yun, limited supply has helped support home prices, and that price growth has added significant value for homeowners over time. In fact, Yun noted that the typical homeowner has gained about $128,100 in housing wealth over the past 6 years. Now, homebuilder sentiment fell 4 points to a 7-month low of 34 in April, remaining in contraction territory. Much of this weakness is driven by concerns over rising mortgage rates, geopolitical tensions, and surging construction costs, which are squeezing margins and dampening momentum in the spring housing market. Buyer traffic, along with both current and future sales expectations, declined month over month. So what is the bottom line? Builders are pulling back as higher costs, elevated rates, and uncertainty continue to weaken demand and outlook. Wholesale inflation rose in March, but not as much as expected. The headline producer price index increased 0.5% for the month and 4% year over year, both below forecasts. Core PPI, which strips out food and energy, came in even softer, rising just 0.1% monthly and 3.8% annually. While inflation remains elevated, these readings came in better than the market feared. On the labor side, initial jobless claims fell by 11,000 to 207,000. However, continuing claims rose by 31,000 to 1.82 million, indicating that many job seekers are taking longer to find full-time work. This week will likely be driven more by developments in the Iran conflict than economic data. The main market-moving report we've seen so far this morning was retail sales, with March's pending home sales also on deck. As we move through the week, we'll continue to keep an eye on initial and continuing jobless claims to gauge how the labor market is holding up as we get deeper into Q2. As of this morning, the 10-year Treasury is sitting around 4.27%, which is essentially flat compared to last week. Hopefully, we see some productive progress on the geopolitical front that helps ease pressure on oil prices and brings a bit more stability back to the markets. I'll be back with another update on Tuesday, but for now, have a great rest of your day.